All right, so I got a few stories I wanted to talk about here, starting with the jobs report. First things first, if you get value out of this video, please like and subscribe. I really appreciate that. So the jobs report came out very, very good. Basically, we got 254,000 jobs created, blowing away the projections of 140,000. The unemployment rate went down to 4.1 from 4.2. Job market outperformed expectations, continued the most robust expansion in history, and even defied possible disruptions usually associated with election year jitters and shenanigans. In short, the American job market is a beautiful thing. So the first thing that I would bring up here is this number overwhelmingly likely will be revised down. The real question is, how much will it be revised down? And we won't know, at least for the next little bit. So this points towards the fact that the economy is, I mean, it's not great by any means. I think it's insane to suggest otherwise. But is it terrible? Is it recession levels? No. So that's the first thing to point out here. And given that, it's probably unlikely that we see a more major market correction in the near future. In the near future, I would be shocked if we seen more than a 5 to 10% pullback, which is normal. That typically happens 2, 3, 4 times a year. So don't be surprised if that happens, but also don't be surprised if we continue to trend up, because the uptrend is still very much intact. If you look at the 50-day moving average, if you look at the 200-day moving average, both of those point towards the fact that we're still in a bull market. Once those start to trend down, especially that 200-day, then we'll be a little bit concerned. But that doesn't look like that's going to happen in the near future. The other important thing, too, is that we are going to be back in earnings season. I'm not sure if it's next week or the week after. I should have looked into that. When bank earnings will come out. So that's something to keep an eye out for, because that's typically the first thing that will drive the markets. And then on top of that, we have the elections coming up in, it's almost exactly a month. Actually, it's just over a month, because it'll be 4 Tuesdays from today. So just over a month. You're looking at about 30, 31 days. And so that will drive the markets as well. Now, honestly, I think either way, the markets will find a way to go up. It's just a matter of we could see some short run volatility, essentially. This chart from Lisa Abramowitz, the U.S. City Economic Surprise Index has turned positive again, rising to the highest level since April. In the past week, bond traders have been getting concerned that they priced in more weakness than warranted. So what this means is basically, well, the economy's better than they were projecting. And that means that they are now not pricing in quite as many rate cuts. From what I've seen, they're still pricing in the 50 basis points for the rest of the year. But on the flip side, I think there was also something like a couple hundred in 2025 basis points, and I still think that's pretty aggressive. The only way I think we get 200 basis points of cuts in 25 is if we get that recession, especially if it's worse than expected. Then for sure we're going to get that. But if we don't get that recession, I would be surprised if we get 250 basis points of cuts over the next year and 3 months. I feel like that's just a little over optimistic or under optimistic, depending on how you're looking at. So that's an important tidbit to keep an eye on, because this is the market pricing this stuff in, and these are people these bond traders are very, very good at this kind of stuff. The next thing here from Jim Bianco, the stimulus announced by Chinese officials over the past week or two has given the Shanghai index a much-needed boost. As the chart below shows, the index is up over 23% in the last 2 weeks, topping any 10-day period in the last 2 decades. That being said, the chart is still up below its October 2007 peak. So Chinese stocks are kind of the big topic over the last couple of weeks, and I just wanted to kind of weigh in and give my opinion. Obviously, this is just my opinion. Everything's my opinion. I think that it's it's overhyped because the Chinese economy is fairly weak. Their demographics are very poor, and not only that, they have a government that likes to get involved in. I mean, long story short, the more involved the government is in an economy, the worse the economy is going to be. The private sector, time and time again, does a better job at solving society's problems. Not 100% of the time with literally everything, but on average, the private sector is much better at solving our problems than the government is. So when you have an economy like China, to where they're very involved and very overbearing, yeah, you're going to see less growth. And a lot of their growth has been entirely artificial. I mean, you look at their real estate sector, entirely artificial. It's not organic growth. When you're looking at an economy, you want that organic growth, and China is not organic growth. And on top of that, they have terrible demographics. And this is something that is not talked about nearly enough, in that a lot of people, not a lot of people, but I've seen some people that have compared them to Japan in like the 80s and 90s. And I think that's not a bad comparison. I think there's definitely some differences, but I don't see what people are seeing in China. I mean, yeah, they have some innovation that comes from there. They produce a lot of cheap stuff. But when it comes to innovation, I mean, yeah, they're innovating well in certain ways, but the fact that they have terrible demographics and their government, I mean, their government could shut down any company overnight and it would not surprise anyone. So I just don't see it when it comes to China. I'm not saying necessarily avoid it 100%. I don't have any individual Chinese stocks. Obviously, I would have some exposure to them through indexes, but I don't own any Chinese stocks. And I don't see any reason personally why you would want to own Chinese stocks. Again, just my opinion. I could be wrong, but just my opinion. If we look at the market over the last week, the S&P was up about 20 basis points. The NASDAQ was up about 10%, or 10 basis points. So the markets were basically flat. But again, if it wasn't for the good jobs numbers on Friday, we definitely would have had a down week. But frankly, the markets are basically within striking distance of an all-time high. The NASDAQ's still, I think, probably 2 or 3% away from their all-time high. I'm just kind of wondering here. Yeah, they're about 3% from their all-time high. But like I mentioned earlier, I still think we're in an uptrend, meaning the path of least resistance is still up. Now, obviously, we could have a volatile week or two. We've seen that over the last couple months. But the path of least resistance, in my opinion, is still up. If we look at the equal weight index, the equal weight was actually down a little bit on the week. Although, again, the trend is still very clearly up here. Mid-caps actually outperformed the NASDAQ and the S&P. They were up about 25 basis points on the week. And like I mentioned earlier in past videos, I think mid-caps are definitely, mid-caps and to some degree small caps, but mid-caps I think are going to outperform. I've said that, I've been saying that for probably 2 or 3 months now, and I still stick to that I think mid-caps, if we're looking at small, mid, and large, if I had to buy one, just for the next year, not necessarily the next decade or two, but just the next 6 months or a year, I probably would choose mid-caps because I think that's where the best value's at right now. Small caps, if the amount of rate cuts we are projecting actually happens, then small caps will do well. But if that doesn't happen, that's going to hit small caps. So, and large caps, I don't necessarily hate them. I just think that there's a lot of them that are overvalued, which I think is going to hurt their returns. Not necessarily they won't still return well, but I think that's going to be a problem. The Meg 7 outperformed. They were up about 30 basis points this past week. They are still down quite significantly from their all-time high. They're down about almost 5%. So that's kind of interesting that you had a week where the Meg 7 outperformed, but the NASDAQ didn't outperform the S&P. I'm kind of surprised there, but crazier things have happened. So the Meg 7 still overvalued. I think Amazon's probably the only one that you could really even argue is fair value or undervalued right now. Nvidia, Tesla still way too expensive. Microsoft still way too expensive. Apple, Google, I think are debatable. They're probably about fair value, give or take. That's just my opinion. Obviously, I could be wrong there. The last thing I wanted to bring up here, basically what I've been doing the last week or so, I sold some calls on QLYS. I sold some 160 calls just because I am down on this position more than any other position that I own. And this stock definitely near term could see some weakness. I still like it long term. Is it a $200 or $180 stock? No, but I still think it's worth 140, maybe 150, and it's at 127. So I think it is a little undervalued, but I still think it could see some near-term weakness. And the reason it's seeing some near-term weakness is that the growth projections have been revised down a little bit recently. So a little bit of definitely some near-term weakness, but I'm not concerned, and I'm taking advantage of that by selling the calls because that's a way to generate some extra income. And if I end up selling it at 160, it's not necessarily the end of the world. I'll return whatever that would be, like 15%. So, and that'd be in less than a year. So I'm not concerned. I think covered calls are very, very advantageous. If you can do it, you definitely want to do it, but you definitely need to know what you're doing. It's not as confusing as some people make it out to be by any means, but definitely want to understand options before you get into covered calls. EQB hit a new all-time high this week. I think it hit 105. It is down a little bit, but EQB has a ton of strength. Actually, I'm up EQB more than any other position in this portfolio, so I'm very happy with them. I will buy more, honestly, if we get another pullback. Even though it's about 5%, I probably would buy a little bit more. I just like it that much. ATD, I talked about them in the Canadian stocks video. I'm not concerned about them necessarily. I'm not necessarily buying because I think they still could experience some near-term weakness, but I'm not concerned. I still think they're a very good company. If we look at some other ones here, EVVTY and Louis Vuitton, I'm looking to buy more of both of them. I think those are both solid companies. They're both a way of diversifying out of the States, even though I'm assuming Louis Vuitton gets a lot of their revenue from the States. Some other companies of note here, Southern Copper, I sold a put on this week. Brookfield Asset Management I did. What are some other ones here? Microchip Technology, I did sell calls on those. I do intend to exit that position if I can sell it for the right price. I'm not sure if that will happen, but I definitely would do it if I could do it for the right price. I'm just trying to see if there's anything else here. I sold an Amphenol put this week. That's a company that I'm looking to enter. I sold a Palantir put. That's a company I'm looking to enter, although I think it's too expensive where it's at right now, so I am just waiting on that. AMP, that's one I sold a put on recently. That's a company I'm definitely very intrigued at. I will buy if I can get it for the right price. And what else are we looking at here? Again, this is how many companies I'm looking to enter. These are all puts, right? So these are all companies that I want to buy, but only if I can get them for a price that's below where they're currently at. And if that doesn't happen, that doesn't happen. In the meantime, I will simply collect premium. I'll make money either way. The question is basically just when. I sold some Meg 7 puts. That's one that I sold quite a bit out of the money. That's probably like 30% below where it's currently at right now. I do not see anything else that is of note here. I have quite a few BITO puts. That's just kind of a way of generating income as well. Nothing else. Carlisle, that's one I sold a put on. That's a company I'm going to make a specific video about in the next day or two. I really like them. I sold another Watts put as well, actually, this week. So that is basically this week. I'm definitely, like I mentioned before, near-term bullish. Medium to long term, as in the next 6 months to a year or two, I definitely could see some more weakness. But in the next 6 months or so, I would be surprised if we don't continue to trend up. But it might be only 1 or 2%, right? Nobody really knows there. So anyway, like I mentioned at the start of the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.